Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Caterpillar was born in 1925 from the merger of two California tractor companies, Holt Manufacturing and CL Best. From tractors in California fields, it grew into the defining name in heavy equipment worldwide.
The company operates three main industrial segments: construction industries, energy and transportation, and resource industries, plus a financial products arm that helps customers finance equipment purchases.
Construction Industries makes the bulldozers, excavators, and wheel loaders you see on every major building project. This is the segment most people associate with the iconic yellow Caterpillar brand.
Energy and transportation is actually nearly as large as construction, serving oil and gas customers, power generation facilities, and rail operators with engines, turbines, and specialty equipment.
The dealer network is one of Caterpillar's deepest competitive advantages. Roughly 3,600 independent dealers around the world provide local service, spare parts, and customer relationships built over decades.
Those dealer relationships unlock the aftermarket business. Once a machine is deployed, Caterpillar earns high-margin parts and service revenue across the machine's entire multi-decade life.
Services revenue, parts and maintenance contracts, now represents roughly a quarter of Caterpillar's total business. That's a more predictable, less cyclical source of income than selling new machines.
The financial metrics reflect a well-managed industrial business. Operating margins have expanded toward 20%, and return on invested capital runs near 40%, exceptional for a capital-intensive manufacturer.
Caterpillar has raised its dividend for over 30 consecutive years, earning it dividend aristocrat status. That track record speaks to the consistency of cash generation even across commodity and construction cycles.
Free cash flow margins run around 15%, and the company consistently returns capital through both dividends and share repurchases, giving long-term shareholders a meaningful ownership advantage over time.
In terms of competitive positioning, Deere is perhaps the closest rival, though Deere is more agricultural focused. In pure construction and mining equipment, Caterpillar competes with Komatsu and CNH Industrial.
Caterpillar's scale advantage in manufacturing and its global parts supply chain mean that in remote or demanding work environments, customers tend to stick with the brand they trust rather than risk downtime.
Jim Umpleby became CEO in 2017 after spending nearly 4 decades inside Caterpillar. He came up through engineering and led the energy and transportation segment before taking the top seat.
Under Umpleby, the company has emphasized services growth, operational efficiency, and disciplined capital allocation, a strategic pivot that has helped lift margins well above historic norms for the business.
Caterpillar's equipment works in some of the harshest environments on Earth: Arctic mines, equatorial construction sites, deep water energy platforms. That demands a global service and support infrastructure few can match.
With operations in over 190 countries and manufacturing on 6 continents, Caterpillar has the geographic reach to serve infrastructure development wherever in the world it happens.
That's the company chapter for Caterpillar. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Caterpillar reported Q1 2026 revenue of $17.41 billion, up 22.2% year over year. Adjusted EPS of $5.54 crushed the $4.65 estimate by 19.1%, one of the largest beats in the S&P 500 this earnings season. The stock surged nearly 10% post-earnings. Mining and infrastructure drove the outperformance. CAT now trades above the average analyst price target.
Caterpillar Incorporated is the world's largest manufacturer of construction and mining equipment, diesel and natural gas engines, and industrial gas turbines. Founded in 1925 from the merger of Holt Manufacturing and CL Best Tractor, Caterpillar operates across 3 segments: construction industries, resource industries, and energy and transportation. The company serves customers in over 160 countries and is a Dow Jones Industrial Average component that has paid dividends for over 90 consecutive years.
At $414.2 billion in market cap, CAT trades at 38.5 times forward earnings, elevated for an industrial, but reflecting the street's conviction in the mining and infrastructure cycle. Beta of 1.52 makes CAT one of the most economically sensitive large caps in the index. CEO Jim Umpleby has led the company since 2017, navigating the 2020 downturn and the subsequent infrastructure and energy cycle recovery.
Revenue of $17.41 billion beat consensus meaningfully and grew 22.2% year over year. Adjusted EPS of $5.54 beat the $4.65 estimate by 19.1%, the largest quarterly beat for Caterpillar in recent memory. GAAP EPS of $5.47 confirms the beat was clean, with no significant adjusted items obscuring the true performance.
Gross margin reached 35.1%, healthy for a capital-intensive industrial manufacturer with significant raw material exposure. Operating margin of 17.7% reflects strong operating leverage. Net margin of 14.6% compares favorably to historical norms for Caterpillar, which typically operates at 10 to 13% in normalized cycles.
The resource industries segment, mining equipment, was the primary driver of the revenue beat. Copper, lithium, and gold mining equipment demand surged as miners accelerated fleet upgrades and capacity expansions ahead of the anticipated battery supply chain build-out for electric vehicles. Caterpillar's autonomous mining truck lineup and aftermarket services drove outsized revenue in the quarter.
The energy and transportation segment benefited from LNG terminal construction and oil and gas field equipment orders. Pipeline to energy infrastructure spending in North America accelerated in Q1 as operators pulled forward capital expenditure plans. The construction industry segment grew at a more moderate rate. Residential and commercial construction spending softened, while infrastructure project execution accelerated.
Free cash flow on a trailing 12-month basis reached $11.45 billion. Caterpillar holds $4.07 billion in cash and is in a net cash position, meaning cash exceeds total debt. This is unusual for an industrial company of this scale and reflects Caterpillar's aggressive debt reduction and consistent free cash flow generation over the past 3 years.
Full year 2026 EPS estimate of $23.09 implies Caterpillar will earn over $90 annually on a 4-for-1 split adjusted basis within 3 years at current growth trajectories. Revenue guidance of $74.1 billion for full year 2026 represents approximately 15% year-over-year growth, a deceleration from Q1, but still well above the long-run industrial average.
The PIN segment, Product and Service Information, generated services-related revenue growing 15% year-over-year. Recurring services revenue from equipment monitoring, maintenance contracts, and dealer support is becoming a meaningful and more predictable component of Caterpillar's revenue mix, reducing the historical cyclicality of equipment-only revenue. The company's trailing PE of 60 times reflects the street paying a premium for this services transition.
Analyst consensus heading into Q1 was 25 buys, 18 holds, and 7 sells, an unusually divided set of ratings for a megacap industrial. The average price target of $722 sits $38 below the current $900 stock price. Caterpillar is one of the rare large caps where the stock has outrun consensus. Analysts have not kept pace with the run.
The bull camp argues the mining equipment supercycle is in its early innings. Copper demand for EV batteries, electrical grid infrastructure, and data center power systems requires mining capacity that does not currently exist. Building that capacity requires years of equipment investment. Caterpillar is the dominant global supplier of large mining trucks, excavators, and underground loaders. There is no meaningful substitute for its flagship products.
The hold and sell camp focuses on valuation. At 60 times trailing earnings on a cyclical industrial, Caterpillar's multiple prices in a prolonged cycle expansion with minimal recession risk. 7 sell ratings from major banks reflect the argument that the stock's current price implies a mining and construction boom lasting at least 5 more years. an assumption that history does not support for commodity-driven cycles.
Infrastructure Act tailwinds are real but complex in timing. The bipartisan infrastructure legislation allocated over $1 trillion over 10 years, but project execution lags authorization by 12 to 24 months. Q1 2026 reflects accelerating project starts, with municipal water, bridge, and highway projects pulling forward equipment purchases. Caterpillar's dealer inventory position confirms demand is outpacing supply in key segments.
The bull case rests on a mining equipment supercycle driven by energy transition metals. Copper, lithium, cobalt, and nickel, all requiring massive mining fleet expansions, are essential inputs for electric vehicles, grid-scale batteries, and clean energy infrastructure. Caterpillar is the infrastructure of the energy transition, not the energy transition itself, a distinction that makes it less susceptible to technology disruption and more certain to benefit regardless of which clean energy technology wins.
The net cash balance sheet is a structural bull thesis. Caterpillar with no net debt can return more capital, invest more aggressively in autonomous technology, and weather any cyclical downturn without balance sheet stress. The company has committed to returning 100% of free cash flow to shareholders through dividends and buybacks over the cycle. A powerful capital return program given $11 billion in annual free cash flow.
The bear case is straightforward. 60 times trailing earnings on a cyclical company is expensive under any scenario. Every major Caterpillar down cycle saw the stock fall 30 to 50% from peak as earnings normalized. The current multiple implies the market believes this cycle has no end date, a belief that commodity cycles have consistently punished.
Tariff risk on imported components is a near-term headwind. Caterpillar manufactures globally and sources components from multiple countries subject to tariff volatility. Steel, aluminum, and electronic components sourced from Asia face incremental cost pressure. Management has guided to offset tariff costs through pricing and supply chain adjustments, but margin compression is possible if tariff escalation exceeds current assumptions.
The 7 sell ratings from street analysts are not trivial. Analysts who cover Caterpillar closely and model the relationship between commodity prices, mining capex, and equipment orders with precision are forecasting a target price 20% below the current stock price. Consensus is not infallible, but when experienced industrial analysts are materially bearish relative to price, the asymmetry warrants attention.
China and Asia construction exposure adds geopolitical risk. Caterpillar generates over 20% of revenue from Asian markets. A slowdown in Chinese infrastructure spending or construction activity, which has been decelerating since the 2021 property market correction, could reduce international segment revenue materially if the North American infrastructure tailwind moderates.
The industrial equipment peer set includes Deere & Company and Komatsu. Deere trades at 18 times forward earnings, a steep discount to Caterpillar's 38.5 times. The gap reflects Deere's agricultural machinery concentration versus Caterpillar's mining and infrastructure weighting. Mining equipment cycles tend to run longer and generate higher margins than agricultural equipment cycles, justifying a structural premium for Caterpillar.
Komatsu, Caterpillar's primary global mining equipment competitor, trades at 12 times forward earnings on the Tokyo Stock Exchange. The valuation gap between Caterpillar and Komatsu is historically wide and reflects the market's preference for U.S. infrastructure exposure and Caterpillar's superior services revenue mix. Komatsu's autonomous mining truck program is a competitive response to Caterpillar's Cat Command platform.
PACCAR, manufacturer of Kenworth and Peterbilt trucks, trades at 15 times forward earnings. PACCAR benefits from similar infrastructure and logistics tailwinds to Caterpillar, but with lower mining exposure. At 38 times, Caterpillar commands the highest multiple in the heavy industrial equipment space, reflecting both the quality of its franchise and the market's enthusiasm for the mining supercycle thesis.
Within the Dow Jones Industrial Average, Caterpillar is often used as a leading indicator for global industrial activity. Its 19% earnings beat in Q1 is a macro signal, not just company-specific. Bellwether performance of this magnitude typically correlates with upward revisions to global GDP forecasts.
Pre-earnings options positioning was bullish. Call volume concentrated at the $850 to $900 strike range for April and May expiry. The implied move was 6 to 8%. The actual 10% move slightly exceeded the implied range. Investors holding long calls heading into earnings were rewarded. The 19% beat magnitude compressed post-earnings implied volatility significantly.
Post-earnings institutional options activity shifted toward $900 to $1,000 calls for the September and December expiry. The positioning reflects confidence in continued mining equipment order momentum through the second half of 2026. The key trigger for this positioning, copper prices above $4 per pound, make large mine expansions economically viable, which historically correlates with multi-quarter Caterpillar order growth.
Insider activity at Caterpillar is limited to standard compensation. CEO Jim Umpleby and other executives participate in scheduled equity vesting programs without significant open market selling. The absence of notable selling at these elevated price levels, stock is near all-time highs, is a mild positive signal, though standard vesting programs make insider data less informative at large caps.
Short interest in Caterpillar has declined to approximately 2% of float, very low for a cyclical industrial. Declining short interest, combined with 7 analyst sell ratings, reflects a disagreement between short sellers covering positions and analysts maintaining bearish targets. The stock has moved against the bears for 2 consecutive quarters.
Caterpillar delivered $17.41 billion in revenue, up 22%. EPS of $5.54, beating by 19%, the largest quarterly beat of the season. Mining and infrastructure drove the outperformance. Net cash balance sheet and $11 billion in free cash flow support continued capital return.
Risks are real. 60 times PE on a cyclical, stock above analyst targets, tariff exposure. Watch copper prices and mining capex as the forward signal for Caterpillar demand. Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.